secrets of money. And the topic for today is debt and loans. This is a hot topic. We all have probably more debt than we should, and we all need access to cash. So today we're going to spend some time together talking about debt and loans, and we're really going to focus in on a couple of topics. We're going to understand debt and really look at what debt to income ratio means. We're going to spend some time talking about the credit impact. We are going to talk about best practices as it relates to credit cards and payment methods to repay debt, especially high debt, and being able to pay that down over time. And we're going to spend some time with those that could have joined us today on some questions and some key takeaways so we can create a highly personalized experience for you today. The real secret of money, you will have to hang out with us and listen on to learn what that is. All right. So we all want to pay off our debt, don't we? We want the freedom from that debt, and we want that to be able to really kind of enrich our lives, right? But it's not as easy as it sounds, is it? So as we're understanding debt, let's talk a little bit about debt to income ratios. So Andre, we're going to do our first poll for today. And what do you consider a good debt to income ratio? Is it 0 to 20%, 21 to 35, 36 to 45, or 46 or higher? So we'll allow a few minutes for folks to answer our polling question today. So those who have joined, please chime in on your answer. All right, we have one person that's answered, a couple more people to answer. Please go ahead and submit your answers. All right, Andrea, I cannot see if all of the answers are in. What is the top ranked answer for our poll today? You are on mute.
I'm sorry, the 31 to 35.
The 21% to 35%. Okay, thank you so much. So before we focus on what that actual answer is, let's talk here about the good debt. Excuse me. Let's focus on the answer here about the good debt. So if you're below 36%, so the majority answered the question right. If you're below that 36%, you're kind of in that okay range. You really want to target below 20% to be in that ideal range. That is extremely challenging to do for sure, especially in today's economic climate, rising inflation and costs and those types of things. And so if you're really focusing in on paying down that debt, you want to get below that 35%. If you're over that 35, 36%, you are in the higher range, and you might find that you're carrying too much debt for creditors to be able to approve you or work with you on different types of loans and those types of things. Now, how do you calculate your debt to income ratio? So you're going to take into consideration your debt payments for the month. You're also going to take into consideration what your monthly income is. And so you're going to divide that and multiply that by 100 to get that percentage. And again, you really want to focus in on below 36%. And so always know what your debt to income ratio is. This is a really good KPI, key performance indicator, so you can better understand your financial landscape. So let's understand debt. I'm going to move some things off my screen here so I can focus on you. Every American, we all deal with debt at some point. We might deal with debt at our entire lives once we start to build credit. But the hope is that we're able to manage our debt down. Debt really begins when we have those maybe college loans, maybe credit cards, and really starting to build what we call good credit. And a lot of times behaviors really take us into some bad debt situations. But we do need debt in order to create a stable and solid financial foundation. And that's where it gets tricky. Defaulting is a very big, real thing in our lives here in America, and it is something where you are not making the payments that you're required to make, and it's creating a lot of havoc on your financial situation. Interest is continuing to increase, and things are really piling up. So let's talk a little bit about defaulting on secured debt versus defaulting on unsecured debt. So secured debt are going to be things that are collateralized, like your car or your house. So if you default on those payments, then you run the risk of losing those assets. The banks then taking those assets as collateral to basically pay that debt. And then when you have unsecured debt, that is like your credit cards, right? And so what can happen over time is they certainly could go to collections, but there's also legal action that can occur when you default. So let's talk about vehicle debt. So car loans, that is called a secure loan because you have an asset or collateralization of that loan. And you have agreed to make certain payments, and those payments are going to be fixed. And so, for instance, in a 24-month car note or car loan, I'm aging myself when I say car note, but car loan is really something you want to focus in on. But that is really hard to do, isn't it? Because the payments are much higher when you have a shorter car loan. So there are car loans that go up to 84 months. And then you're going to be paying a interest rate for that loan and having that privilege of that loan. And your payment is also going to include things like taxes and titles and fees. Your car depreciates right when you drive it off the lot. You can't get away from it. And at the end of a year, your car is going to depreciate between 20 and 30%. This is a big deal. So a lot of people can get very backwards on their car loan because of those long loans and then the depreciation that happens. So you really need to be smart about your purchase. A lot of people love the purchase of premium and high-end luxury vehicles because it's an incredible experience, but it's something you absolutely need to be prepared for. They hold their value a little bit more, but think about that. You're driving off the lot of the car lot and you've already have something that the value has dropped significantly. And that's a huge impact on your financial landscape. So thinking about when you go for a car loan, something to consider. So if you're shopping for a car and you're shopping in a short period of time, say 2 weeks, you're going to be okay with those credit pulls. So you're going from dealership to dealership. Maybe you find multiple things that you like and you're trying to kind of figure out how all of it's going to work financially, and you get a credit pull. As long as it's within a couple-week period, you're going to be fine. It's still going to be on your credit report, but it's not going to be a negative impact. But if you are looking, let's say, over a 3 or 4 month period, be very, very careful, because if you're spreading out the evaluation of your credit for a purchase of a car, that could have a long-term negative impact on your credit report. So some financing options. So dealership financing, a captive financing options, you've got these things available to you. The dealership financing typically happens when there's a big inventory they're trying to get rid of. They're giving you some deals maybe on the pricing of the vehicle. They're also giving you some deals on the financing options. Always understand that a dealership financing, just like a captive financing, that is a revenue stream for them. So they are making money in addition to the sale of the vehicle. So you really want to ask as many questions about the financing as you do about the vehicle to understand your true costs. And you also have to know that you still have leverage when negotiating these things. So the captive is really through those large automakers. Tesla has something like that. So what happens is they have financing deals at these big car manufacturing. Now, emerging into the market are going to be your online lenders. Tried and true is your credit unions. Something to note about credit unions, they also have online loan applications. And if you go through a credit union and you do a full online option, a lot of times they'll take 0.25% off of your interest rate. So not only do credit unions have these wonderful interest rates if you're a member of that credit union, but they also have some benefits to you for the online processing. And they're really underutilized because it's only 18% of car loans. And I think that's just because everybody goes to a bank or your dealership has a bank option and bank relationships. Again, dealerships, that is a revenue line for them in some way, shape, or form. It could be a referral fee, it could be something else. So when you're using a bank tied to the dealership, just be very smart about what you're paying. You can also go directly to the bank to secure your own loan and then buy the vehicle. All right, repaying your car loan. So something to think about in order to repay your car loan is really cash flow. A lot of times when you're buying a new car, it's a larger expense than you're used to. And so that monthly draw is going to be a bigger hit on cash flow. So one of the recommendations is to pay it biweekly. Every couple of weeks, you pay a portion of your car loan. So it doesn't have such a huge hit on your bank account. Then you can also make a larger payment each year. Let's say you are someone that maybe has a higher withdrawal from your payroll, so you get a tax return. When those tax returns come in, it would be a wonderful thing to pay more or pay an additional payment on your car. And then rounding up is always a great thing. It could be rounding up to the nearest dollar, to the nearest $50. It could be the nearest $5. Anything extra is going to help you pay that principal and then long-term save you money. So also what you want to do is you always want to ask questions. So let's say you have a car for a period of time, maybe a year. You want to kind of start asking some questions in order to get maybe better financing options, interest rates, those types of things. It never hurts to ask questions. Again, just be mindful of those credit pulls. And there are some loans, interesting enough, that you take on a vehicle, and if you pay it off early, you have to pay penalties and fees, believe it or not. So make sure you're asking those questions as well. And getting upside down on a car is very easy to do because you're trying to manage your car loans payments lower on a monthly basis. And so what happens is you extend out to the max. Maybe it's that 84 months that we talked about earlier. And then when you think about the depreciation, the value of the car, you're thinking about how long you're paying it for the smaller payments. It is very easy to get backwards on a car. So the key here is to make sure you are focusing on vehicles that are economical and within your budget. Don't just look at that monthly payment. Look at everything overall, because you're going to get into that car a couple years down the road and you are going to regret your decision. So really hit pause, think about it, and think through ways that you might be able to put a down payment on that car, ways that you might be able to budget differently to have shorter terms and higher payments on a monthly basis. And then if you are coming across a really high interest rate, do not do it. Start taking a closer look at some of your other options. Maybe it could be something that's not necessarily through a dealership and it's a private sale. So you always have options. Don't feel like you're backed into a corner. All right. There's always the National Foundation of Credit Counseling too. So if you are backwards on your financing, you have your car's in good condition, all of these types of things, know that there's help out there that's free. So you can always contact those types of agencies. Usually they're nonprofits, and ask questions and find out your options. When you get your car repossessed, that doesn't mean that your debt is relieved. You still have to pay what your obligations are on that debt. 5,000 vehicles get repossessed a day. And so this is a problem in America, and it is a challenge for many, many people. So understand what your obligations are if you do have your car repossessed. Make sure you understand what obligations for maybe your interest payments, if they have sold the car, maybe they sold the car under value or under your note or your loan, excuse me. And so you still have to pay off that loan. And again, those nonprofit credit agencies, they offer the help, and dial them and find out what help is available for you to be managing through. They will not relieve this debt for you, but they will help you manage through your options. Credit card debt, wah, wah. So credit card debt is so scary, and it's everybody has been challenged with credit card debt even at any part of their time of their life, excuse me. And so when you look at these numbers, you look at the 6% over 10,000, you think about that, and that doesn't seem like a very large number now, does it? But over 14 million people in the US have more than $10,000 of credit card debt. And when you think of what credit cards are intended to do, it's intended to help you with cash flow. It's just not free money, is it? And so what happens though is we're getting ourselves backing into a corner where we don't have emergency funds. And so we're having to use credit cards to pay for things that are emergency situations. And that's really what's happening. Over 55% of people carry credit card balance from month to month. And credit cards are intended to be paid off every single month. So when you think about where credit cards came from in the birth of credit cards, it was to help with that cash flow, getting you to that next paycheck, getting you through that month. It was not intended for you to carry balances month over month. Now, the credit card companies want you to think that for sure. And that's why they get you all of those incredible promotions and all of those incentives to use their credit cards. So if 40% have been free from credit card debt haven't been free since 2018 and 15% since 2006. That's a long time to hold debt and carry debt. So this is a real problem. So when you think about payment cycles, you're going to think about a monthly payment cycle for your credit cards, and what purchases you have in that monthly period is going to be billed to you, and you have about 20-25 days in order to pay that bill. Now, remember, this is a loan. This is not cash on hand. This is a loan. And so this is going to be called revolving credit. Paying credit card tips, just be proactive, pay early, definitely pay the minimum required, consider some type of automatic payment of your credit card debt. And take a closer look at your expenses and just be smart. Pay more than your minimum when you can. Pay multiple times a month. Like I said, that lump sum on a monthly basis sometimes is very challenging. But if you're looking at it on a per pay basis or twice a month, it sometimes gets a little bit more manageable from a cash flow standpoint. And budgeting. So budgeting and planning is going to be key with your credit card payments. And so one of the things that we teach in our budget workshop, which we are going to be holding next month on the third Wealth Wednesday of the month, is a budget workshop. And we really focus in on your money mindset. Knowing your money mindset and how you look at money and how you behave with money is key to selecting the right budget. A little bit of a dangle the carrot there for next month. So default on credit card debt, this is going to impact your credit history. This is going to last a long time. You're going to carry this for about 7 years on your credit report. And this is something that you really need to think long and hard about before defaulting. So if you have to make tough decisions about finances, know what the ramifications are. You're probably going to get some notifications from your credit card companies, like a 30, 60, 90 day. And then you are probably going to go to a collection agency. And these collection agencies are tough. They will find you no matter how hard you try to hide, and they could take you to legal action. But recovering from credit card default is possible. It just takes time. It takes being vigilant. It takes being focused and disciplined. And what you want to do is you have to pay that outstanding debt. Just because you default does not mean you're relieved of any of that debt. You have to make sure that you are really talking to people, asking questions. There might be a 0% credit card that you can do some transfers to help you pay down that debt. And then get rid of those cards. We talk about cutting them up and getting rid of them. Don't even have them in your possession. And just make sure that you're not adding debt to those cards. Negotiating with collections, you want to make sure everything is written down. Make sure you understand it clearly from the credit card companies, and that you have things very detailed and very specific. Check what the allowance might be or the acceptable amount might be for partial payments. And when your debt is paid off, request that you receive that in writing as well. Credit repair. There is nothing that a credit repair service can do that you can't do for yourself. Now, there's expertise and information that you can certainly gain from a credit repair service for sure. We've touched on that here today already, but this is something that you have complete control over. So you need to stay focused on your accounts and ask the questions of your creditors. There is no quick fix. You may have gotten into that debt quickly because you went on shopping sprees or maybe made some decisions that you shouldn't have and spent that credit card money. Maybe it was a large credit card expense because you didn't have that emergency fund available to you. So there is no quick fix. You're not going to do this in a couple of months. This will take years, but you can absolutely repair your credit. And again, that credible repair organization like the NFCC can really help you understand your options. But be careful, there are fraudulent credit repair companies out there, just like every single industry. This one is not, credit repair is not immune. There are going to be bad players out there in the market, and they're going to claim that they can get rid of, they've got the magic, right? They've got the magic. They're going to clear your bankruptcies. They're going to clear all your reports. They're going to do all of these things. And so do your research. Fortunately enough, we have a lot of ability at our fingertips to research and vet out fraudulent firms and really also understand those nonprofits, those firms that are just and right for you to work with. And at the end of time, you could absolutely have waste of time, waste of money, and maybe some legal issues if you choose a credit repair company that is fraudulent. All right, student debt. If you tuned in last month, we talked a lot about college funding and student debt. So check out that YouTube video, that LinkedIn article, that blog to learn more about college funding. Alarming statistics. So we have been reading the news on social media. We all know that student debt is huge. Over $30,000 just for a bachelor's degree. And in many cases, that's six-figure debt. And think about 20 years of paying off $30,000 and if you have a six-figure debt. So taking on student debt is very, very serious. And it can follow you for 20, 30, 40 years. So what is student debt? Just like a loan, like an auto loan or a mortgage loan, you are borrowing money. You have to pay back that principal and there's interest charged on that. A lot of times what happens is payments aren't structured until after you graduate. And so that is something that can be considered in deferment. There are federal and student loans available. And again, check out last month to learn a little bit more about funding sources for college. Deferment and forbearance. So in deferment, no interest, but will accrue on your loan. But when you're in forbearance, you get that interest that accrues on that loan. And when eligible, these are uses for the following. So you want to have, when you're going into like temporary postponement or reduction, some of the reasons to be able to do that would be the financial difficulties, medical expenses, changing in employment, or other situations that might be acceptable to your lending source. So again, what's key here? Communication, asking questions, making sure that you are staying connected with that organization that issued that loan. Just like everything else we're talking about, see what you can do to make additional payments if you can afford them. There's part-time work during school while you're going to school in order to start making those payments a little bit early. Stick to a budget, maybe take a lower amount because of that additional part-time job, and then take advantage of any tax deductions available. We go into that pretty extensively in last month's Real Secrets of Money. And then consider refinancing your loan. So after graduation, you've had good repayment of your loan. There could be some options to refinancing for a lower interest rate. Default, just like any other default, this is going to be very negative, something you absolutely do not want to do. You are going to still have obligations for paying off the loan. Interest implications and fee implications could be very serious, just like any other loan, car loan, mortgage, those types of things. But defaults happen very frequently because of the cost of college and then the disconnect between employment and education expenses. So what has to happen is you really need to have a solid budget, and you really have to have a funding plan that is a little bit more substantial, and the loan amount should be a smaller percentage. Consequences of default: you're going to have a negative impact on your credit scores. You could have wage garnishments from your future employer. You can also have tax refunds withheld. And then think about the legal action that could also happen. So this, again, is very serious. Forgiveness programs. There are forgiveness programs out there for federal loans, and some of those are listed here. So if you are in a situation with student debt and you're looking for your options, I would double check with, again, that program that we provided last month, but there are agencies that can help you navigate through the system to make sure you're finding a win-win scenario for you. So debt repayment methods. There are a couple of methods that we really focus in on when working with our clients. We're focused in on that snowball or avalanche method. And it just depends on you and who you are. There are two different approaches to paying off debts, and there are pros and cons for each. Focusing on the snowball method, this is a common method for folks that really need to see those early wins in order to continue to have that momentum of paying off their debt. And so you pay in this method, you're going to pay your smallest debt first and pay that off. And then you go to the next largest and then the next largest. And basically what happens is your payments start to snowball. So list your debt from that smallest to the highest, and then you determine what extra you can afford to put into the minimum payment on that smallest debt. So let's say your smallest debt is $1,000 and you typically spend $20 a month on your minimum. Can you do $40 a month? Can you do $50 a month? Keep the minimum payments on the other outstanding debts. Don't change what you're doing on the minimum payments there. And then once that small debt, like I mentioned, is paid off, you go to the next size debt. That is what happens when you get larger payments to those larger debts. That's where that snowball method happens. So the pros: it works well for those that need that mental boost, like I had mentioned, and you get to celebrate your success. The strategy shows you some early wins and really does help you from managing some of that stress. But at the end of the day, you could be paying, and you will likely be paying more in interest over time. Now, the avalanche method is the exact opposite. So you are going to focus on your highest interest rate first and your highest debt first. Once that is paid off, then you're going to allocate money to your other accounts. Again, you're going to list your highest to your lowest. You're going to determine how much extra you can contribute to that particular account at the top of your list, and you're going to continue to pay minimums on all the other accounts. The pros here: mathematically, it just works. It is going to be an efficient strategy for you because of what you're doing to pay down that debt and minimize your interest rates. It is a faster way to pay off your debt overall as well. And you're going to save that money in the long run. Now, the cons: it is tough, especially if you do have high interest, high balance accounts. It is very tough to see that progress early on. But if you are diligent and you're determined, this is a great method for you. So moving right along, we're going to talk about the cost of money. We've got our next poll here. So those that are with us today, please put in your answers to the poll. Andrea has that up. Do you know what the cost of money means and how it impacts your decisions to take a loan? If you do, A, yes, I fully understand it. B, I've heard of it, but I am unsure. And C, no, I'm not familiar with that concept. All right. So Andrea, like the last poll, once you have all of the answers in, will you please share with me what that?
So we have the highest B, if I heard of it, but I am unsure of how to calculate or apply it.
Okay, got it. I've heard of it, but I'm unsure how to calculate or how it applies. Got it. What the cost of money is really an evaluation on the price you're paying to borrow funds and then the lost value of those funds. So if you think about it kind of in simplest terms, you are going to, let's say, buy a car and your car interest rate is that 3.9%. But you know you have a high yield savings account that gives you 4.8%. So almost a percentage and almost 2%, I should say, different, right? Or a percent different. And so the thinking is, are you going to make more money if that down payment is kept in your high yield savings account versus taking that down payment out of your high yield savings account and putting a down payment on your car? So that's a little bit of an easier one because a high yield savings account is a savings account just like your bank, but it gives you a higher interest rate than typically a bank does. And everybody buys a car. Wouldn't it be great to always have that 3.9%, right, on a car? But that is a very simple way of looking at it. In this scenario, your money is better off earning a higher interest rate. So pulling that out to do a down payment on a car would not make sense. Again, a very simple, there's more variables there, but that gives an example of what cost of money is. So you want to obviously look at debt and the lower, more manageable interest rates and the ease of paying those off. You want to make sure you really have a clear purpose for good debt. Some debt is good, right? We always talk about relieving ourselves of debt. We talk about being debt free. It depends on, you might be a Dave Ramsey or a Susie Orman. That's kind of a one size fits all program where we really customize our coaching and our financial services to the person. And there's absolutely good debt. And so the things you're thinking about are that low interest rate. You're thinking about what that investment or asset is going to earn you over time, like in an investment in a home or a second property. You want to understand kind of the manageability of the payments, make sure you're comfortable with those payments in your budget, and even pre-plan those extra payments or that additional payment to principal. And then some of the debts are just really good debts to have because of the tax implications. So you can mitigate your tax exposure, or it may actually offer you some tax deductible interest. So good debt does exist. Free from debt is always amazing, but when you're strategically looking at your financial landscape, you really want to make sure that you're doing a valuation of good debt. And again, debt-free, imagine yourself debt-free. So when you think about one of the mindsets to understanding money and managing your money is just really imagine yourself debt-free. What does that look like? What does your life look like? What does your day-to-day look like? What does your freedom look like? And so when you stay really focused on that, it's a lot easier to make some decisions on some of that debt. So reinforcing a debt-free strategy, create a budget. Tune in next month. We also have a YouTube video on our YouTube channel and a blog on our blog page that talks about budget and budgeting methodology. But tune in next month with us, hang out with us, and we'll have a budget workshop. And we'll go through some of those money mindsets and the right budget methodology that fits your money mindset. Stop adding more debt. It's just as simple as that. Just stop. Don't look at those credit cards as a bucket of money. Look at that credit card as getting you to your next paycheck where you can pay off that balance. Build an emergency fund. You should have 3 to 6 months in an emergency fund. And so 3 to 6 months of your expenses should be saved in an account. We always recommend a high yield savings account that doesn't have any minimum balances, does not have any type of fees or transaction limitations. They are running right now about 4.5%. Some are running at 4.8% that I referenced in the cost of money slide. So you want to really be smart and maximize your money, not just save your money for emergencies. And then don't forget to celebrate your wins. It doesn't matter how small they are. It doesn't matter what they are. Give yourself a pat on the back, give yourself a high five, happy dance, celebrate those wins, because that's when you know you've taken control of your money. So thank you for joining us today for our Real Secrets of Money, Debts and Loans. So the real secret for today was what? Some debt is good. Another secret for today was really the cost of money, and you have options. So we've covered a lot about understanding debt, managing strategically, and giving you some tools in order to strengthen your financial position. So what we ask you to do is contact that person that invited you to watch this video, or if you're seeing us on social media or YouTube, drop a comment, schedule a time for us to chat, no obligation discovery session. We love